Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we've had a pretty significant turnaround in terms of market sentiment from the beginning of last week to the beginning of this week. The beginning of last week, we saw a near unity across the markets with regards to optimism. You had the expectation of what it was a certain rate cut at the beginning of last week. You had um, a a cooler than expected inflation print the previous Friday that basically suggested that the Fed was all clear in terms of cutting rates, not just once in October, but potentially another time in December and multiple times in the early parts of next year. And then also just news that seemingly trade negotiations were going relatively well across Asia, specifically with China. That kind of gave markets a very positive tone here at the beginning of last week. Fast forward this week, you had the Fed cut rates last week, but come in with a much more hawkish tone with regards to whether or not they were going to cut in December and expectations for next year. That certainly poured a lot of cold water on the optimism for the markets. And then you had tech earnings last week that were largely good, but investors were starting to show some concerns with regards to the size and speed at which these major tech firms are competing to build out their AI infrastructure and compute for the near future. And I think that's starting to make its way through the markets. We're seeing some of the negative reactions this morning with regards to Palantir's earnings announcement. So we're really kind of starting off this week on a much more negative tone here, with just expectations for rate cuts being tempered substantially from the beginning of last week, and just overall investors being more cautious and more concerned about the fact that the S&P is trading at nearly 23 times forward earnings, and the Nasdaq is trading north of 28 times forward earnings. That there's concern that there's a higher probability of a pullback here in the broader markets. And one thing that I think is worth pointing out here, as you can see on the S&P 500 chart, basically since the middle of May, we've had this very straight and upward to the right trajectory to the S&P 500. But if you track momentum here since May, as markets continue to make higher highs, momentum continued to make a lower series of highs. And this negative divergence is showing that buyers are getting more and more exhausted as they continue to move higher here. And that leads to a higher probability of a pullback here. We saw a recent pullback here, a very shallow one that kind of continued to move its way higher here. So, could this be the start of a call it a healthy correction here within the markets, talking somewhere in the 10 to 15% range? I think that is very much potentially on the cards given kind of where markets have headed, because yes, corporate earnings have been strong, but we've also seen multiple expansion alongside with that, and we're seeing multiple expansion at a rate faster than corporate earnings are rising. And I think that's starting to lead us to be a little bit more cautious, or leading us to be more cautious here with the broader markets. And you add on top of the fact that market breadth here in the last few weeks have been incredibly poor. If you look at market breadth here last week, you saw more stocks make a new 52-week low in the S&P 500 than stocks that made a 52-week high. That's a pretty strange thing to see when the S&P is making a record all-time high. So what we're seeing is just a lack of participation in this broader move here in the equities rally that we're seeing here, that is really concentrated in a relatively few high-tech growth names, and that the vast majority of the stocks in the S&P 500 is failing to keep up with that particular move. And that is in itself not necessarily a bearish signal, because the other way that that can resolve itself is the fact that it can resolve itself in a way where the rest of the marketplace catch up, But I will say that I think we're at a stage where that is looking less likely as a scenario of what's going to happen, where the rest of the market plays catch up while kind of the AI stocks takes a bit of a breather. But that's not out of the cards. So as you look at kind of the markets right now, the S&P 500 is kind of at risk of a bit of a pullback here, at least into the 650 area here to the downside in the short run. If we break below 650, there's not a lot of support until around 6,200 here. That's really the major support here to the downside, or 620 on the SPY. So those are some of the technical levels that I would be paying attention to right now here on the SPY. If you look at the Qs, very similar chart here. Whoops. If you look at QQQ, which is the ETF that tracks the tracks the Nasdaq 100. Similar type chart here, higher highs in price, no longer making higher highs in terms of momentum. You did see a little bit of a confirmation here on this recent high here, but that doesn't take away from the fact that we see a significant amount of divergence here. You have some minor support here in the 590 area on the Qs, but the major support here is really going down closer to 550 here on QQQ. Those are some of the technical levels that I would be paying attention to here on the Nasdaq 100. And then if you look at a chart of IWM, the small cap ETF, you see that over the last month and a half, this stock is small caps have really gone absolutely nowhere, while the S&P has made new record highs, and that's showing us that there's a higher potential here for a bit of pullback here in small caps. But also, if you look at the equal weight S&P 500 index, that also over the last nearly 3 months have really made no progress here as well. So this is really just showing you how that the market breadth over the last 3 months continues to get poor, and that's again not a healthy sign here for market rallies hitting new all-time highs when there isn't participation on that move here to the upside. So that's kind of where we stand here right now with regards to the broader markets. So let's take a look at some of the ideas here for this week. And as we look at kind of how ideas have evolved here over the last few weeks, we continue to find ourselves in a scenario where we're seeing far fewer bullish opportunities in the markets. One, just because a lot of stocks are overbought. It's hard. We generally don't like to buy stocks when they're at record highs, hoping that they continue to move higher. We much prefer waiting for pullbacks, waiting for stocks to kind of sell off in order to be buying opportunities. And there's just very few of those. And for the few that are exhibiting those types of technical levels, from a timing and charting perspective, very few of them have the valuation or fundamentals to align with it. So we find ourselves to see far more bearish opportunities in the market. So, today what I'm going to show you is a fairly even mix of bullish to bearish opportunities, where traditionally speaking, we typically would have far more bullish opportunities in these types of market conditions. So let's take a look at kind of where we stand. The first one I want to take a look at here is Lockheed Martin. Lockheed Martin, as you can see over the last, call it year or so, has kind of traded below this 480 level. It's been range bound between roughly 410 and 480. Back here in September, it finally broke out above that 480 level, traded all the way up into the 500s, and now it's pulled all the way back to that 480 level as a new support level. And the question is whether or not this can now bounce higher here. Lockheed Martin's interesting because it trades at only 16, 17 times forward earnings, which is nearly half the valuation of its peers. Now, you could argue that Lockheed Martin trades at a discount because it doesn't grow revenues as fast, and it doesn't grow its profit margins are slightly lower than the industry. So for those reasons, generally speaking, it should trade at a valuation that's lower than its industry, but not, in my opinion, at a 50% discount. The revenue growth is coming in at around 4% versus 9% for the industry, and profit margins are around 6% versus 8% for the industry. So, it doesn't grow as fast and it's not as profitable, but I don't think that justifies a 50% discount. So for those reasons, I think Lockheed Martin has some upside potential here, especially from the technical level. It makes some sense. The next one I want to take a look at here is Gilead. Gilead, this is an interesting stock because we had it as a bullish stock here that we kind of earlier this year when it broke out here above this 116 level here, but because it kind of came back below that level, we got rid of it. But recently broke out here above again, came back to retest this level of support, and it's starting to bounce higher here. So we think the timing on this is better the second time around because the fundamentals still look just as compelling. It's trading at around 13, 14 times forward earnings, which is just in line with the industry. But if you look at revenue growth and EPS growth, it is either in line or exceeds its industry. And then more importantly, net profit margins are almost 30%. We're talking 28% net profit margins versus the industry average is closer to around 16. So you're talking about a stock that's growing faster than the industry, more profitable, but trading at the same valuation as the rest of the industry at only around 14 times forward earnings. That's why I think the upside potential is there from a fundamental perspective. And now the timing, I think, makes a lot of sense to potentially look at Gilead, given kind of where it's trading right now, especially now that it's broken out above that level, came back to retest it as support, and is starting to show some strength here off of those support levels. So Gilead is one of the few bullish opportunities that we see here in the markets. Another one here is not a particularly sexy one, but in these types of market environments where you're seeing more volatility, being more defensive with stocks like utilities sometimes makes some sense. And that's what we have with PCG, Pacific Gas and Electric. And I'm sure many of you viewing this today may have Pacific Gas and Electric as your utility provider, and you probably aren't too thrilled with them as a utility provider. And I don't know anyone is necessarily with their utility providers, but as a business, it trades at around under 10 times forward earnings, which is nearly 50% discount to its peers. And as you can see, this stock has clearly struggled here in the last few years, but it's starting to show some signs of life. It kind of broke out here above 14, formed a base here above 14, started to trade higher here, pulled back, and we're seeing if this starts to form a new base and has the opportunities to start moving higher here because again, from a business perspective, it looks fairly compelling from a valuation since it only trades at 10 times forward earnings. Look at growth expectations and profit margins. It is slightly below the industry's in terms of growth and profit margins. So it should theoretically trade at a discount, but in my opinion, not at a 50% discount. And that's why I think the upside potential is there, especially since they have been focusing in the last couple of years in turning around their business, mitigating wildfire risk, burying utility lines rather than having them exposed, and and clearing out brush, around kind of where the major substations are. That's kind of what they've been focusing on. And then you add on top of the fact that they've been trying to win some business with regards to data centers and the build out in terms of AI data centers. So you look at all those things combined, they seem to have what looks like a somewhat compelling business opportunity, especially as they start to turn around their business. The next one I'll take a look at here is we'll take a look kind of from a timing perspective because Meta obviously on earnings last week took a bit of a dive here, but as you can see, it just generated a counter trend buy signal here. And this is a stock that clearly took a dive in the last couple of days, but I actually think that the sell-off presents an interesting opportunity for those who who are willing to be a little bit more contrarian and take on what might seem like more risk, but in my opinion, is actually less risk because you're buying it now at a much more favorable valuation. Because last week, I really thought Meta at 24 times forward earnings was compelling because if you look at growth expectations, Meta's expecting to grow revenues by about 17 to 18%. Not many companies, certainly not of their size, but not many companies altogether are growing revenues at 17, 18% year over year, let alone a company of their size. And then you add on top of the fact that profit margins, is north of 30%. there's just very few companies that are generating net profit margins north of 30%. So when you add that kind of growth and that kind of profitability together, generally speaking, stocks like those trade at a much higher multiple, closer to probably 30 times forward earnings. But Meta last week, before the earnings, was trading at 24 times forward earnings, which I thought was a compelling valuation given how fast it grows and how profitable they are. But now that the stock has been hit quite a bit here, and arguably the earnings announcement last week was a good earnings announcement. The reason the stock sold off was because investors were a little bit concerned about Meta's spend on AI. Yet you look at kind of every other company that's spending on AI, and they have not been hit, which is why I think this presents an opportunity, and this isn't necessarily a reason to run and hit and run for the exits. Especially if you look at Amazon. Amazon's announcement yesterday that that they're going to be building, an AI data center with NVIDIA and spending more money than they originally announced. The stock was shot up, another 10% here. I can't help but think that in Meta at 21 times forward earnings, which is a discount to the average S&P 500 stock, is not an interesting opportunity for those who are looking for a long-term opportunity and is willing to be a little bit more contrarian. So I quite like Meta here at 21 times forward earnings on the sell-off here in the last week. Alphabet remains kind of on our list here for the same reasons. Fortinet is another one that we're taking a look at here. Fortinet, as you can see, this is a stock obviously has taken a bit of a hit here this year, but started to show some early signs when it broke out here above this $81 level, formed this base here, and is now starting to break out higher here. Again, our upside target here is 97. That's our upside target. Fortinet is a slightly more expensive stock, is trading around 30 times forward earnings, but they're expecting to grow revenues by about 12%. And similar to Meta, has net margins north of 30%. This is what I mean in terms of stocks that are growing that fast and have profit margins that are north of 30%, usually trade closer around 30 times forward earnings. Meta is pretty unique in the sense that it has all of those similar metrics and arguably better metrics in terms of faster growth than Fortinet, yet it only trades at 21 times forward earnings. Alphabet, like I said, it's very similar to Meta. Trades at around 24 times forward earnings at this stage. Well, actually, based on the move here last week, is now trading around 25 times forward earnings. But similar to Meta, it's growing revenues and EPS in that 13 to 15% range. Net profit margins of 32%, trading at 25 times forward earnings, suggesting that there is still some potential upside here from where it's trading at right now, even though the stock has had a really nice run here so far. And then lastly, Micron. Micron is very close to our upside target here. Our upside target is actually 235. So arguably, we've already reached our upside target here for Micron. So maybe I'll hold off on talking about Micron because it essentially, I don't necessarily think is a new opportunity right now. I think if you have some Micron stock, we are at a level where I would say this stock is probably fully valued and is worth potentially trimming some of that exposure if you are long that stock. This is a stock that we have talked about a lot in the last few months. Okay, so now looking at some bearish opportunities. Microchip, this is one that I've been taking a look at. Microchip, as you can see over the last few months, have really struggled here. Notice how the trend quality, which was green all the way through, has turned kind of as the trend quality has deteriorated and now it's turned kind of to all red. This is showing us that the trend is starting to turn much more bearish here. Our downside target here is $50 to the downside. Microchip trades at 43 times forward earnings. This is a very expensive stock for a company that essentially makes garage door openers. Now, they grow quite fast. EPS growth is close to 40%. Revenue growth is around 15%. So that's part of why it can justify relatively high valuation. But Microchip is not profitable. Microchip is losing money every single quarter, and they haven't turned a profit in a while. And that's part of why I think the valuation is a concern for me, trading at 42 times forward earnings. And I think that in this market environment where investors are a little bit concerned, that's really where I think these are the types of stocks that can come in relatively quickly and see a big move here to the downside. Um, the next big stock I want to take a look at here is Apple. I've been an Apple bear for a while, but when it breaks higher here, you have to kind of be cautious. So, I was an Apple bear back here, I was an Apple bear back here, I was an Apple bear back here, and these were all sell signals that I had given on Apple. Basically, when every time it rallied, I thought this was an opportunity to be a seller. Until the stock broke out here above this 215 level, it kind of formed this base around 215, broke out here, and that's when I stopped being an Apple bear. From the perspective of the timing just wasn't right. The technicals don't make sense. But now that we've rallied from 215 to 275, now we're starting to see some of the signs where I think we could get back into a bearish position here in Apple. And you can think of this as also kind of more of a macro bearish view here as well, since Apple, pretty heavily kind of tracks kind of a bigger macro picture as well. As you can see on last week's earnings announcement, the stock, despite reporting what was by analysts and investors would have considered a stellar earnings, the stock initially popped, but basically closed below the previous day's close. That kind of price action is not a particularly good sign when a company, quote unquote, reports good earnings. And you have some signs of buyer exhaustion here to the upside. But what it really comes down to is the fact that Apple trades at 34 times forward earnings. Now, remember when we were talking about Meta and Alphabet, the companies that are trading at 21, 25 times forward earnings, they're growing revenues in the 15 to 17% range. Apple's growing revenues at under 6%. Their sales have slowed down substantially. EPS growth is only growing at around 9%. So, that's the type of growth expectations that you don't typically associate with the stock trading at 33 times forward earnings. Now, I will say net profit margins are quite healthy for Apple at 26%. So, it's not quite as high as Meta and Alphabet and some of the other like Fortinet that we're talking about here, but it's respectable at 26, 24, 25%. But does that justify 34 times forward earnings when the company doesn't really grow that fast? I think that that's kind of a stretch in my opinion, and that's why I'm a bear here at Apple. And then you just add on top of the fact that Apple has really fumbled their AI rollout, and to this day still does not have a reasonable solution for their product from an AI perspective. And then you add on top of the fact that where they have spent the last 10 years and $100 billion investing in what is meant to be the next iPhone or the next iteration of what the evolution of smartphones are going to be in the form of AR. It's very clear that they're not particularly in the lead in that particular space, that Meta and potentially Snapchat are far more ahead in terms of commercially viable products. So for those reasons, I'm not as bullish here on Apple, and I think at 34 times forward earnings is incredibly difficult to get your arms around, and I think there's potentially some downside ahead for Apple. Next one I want to take a look at here is Dutch Bros. For those of you that are in the Southwest, you're probably more familiar with this. They are a iced coffee chain, very fast growing, very popular iced coffee chain. This stock, as you can see, since the beginning of this year, has really struggled. It's had multiple attempts at trying to rally here, but each one of them have fizzled. And now that's kind of broken down below, I think there's some further downside here ahead. Now, part of it is also the fact that it trades at 61 times forward earnings, which is more than about triple the average in terms of the industry. Now, in many ways, you can sort of justify a higher valuation because they grow incredibly fast. They're a small company, relatively new in the last few years, and but growing very fast. They're growing revenues at about 25%. They're growing EPS at around 33%. So we're talking about numbers that are kind of closer to the Nvidia numbers than McDonald's, if you will. But the problem is that they're not particularly profitable. Net profit margins are under 4%. A lot of these kind of a lot of food companies overall have thin margins, but this one has a particularly thin margin at under 4%. And that's really kind of where I think a lot of this falls apart. You have fast growth, but if you don't make any money, it's really hard to justify a very rich valuation. We've seen that if you look at companies like Chipotle, they were always trading at a rich valuation, but they had profit margins to kind of back it up, if you will. But you look at companies like Kava and some of those fast growing startups, those valuations have come in substantially. And I think that we're in a stage where companies like this, like Dutch Bros, will start to see some of that here as well. The next one I want to take a look at here is Kroger, the supermarket. Many of you in the US are familiar with Kroger. This stock has really started to fall apart a little bit here. We've seen a lot of supermarket stocks this year fall apart. If you look at Sprouts, you look at Albertsons, those have started to fall apart here. And this is an important technical level here in this, call it the $64 level here, that it just recently started to break below. So Kroger's is not expensive. It's trading at 12 times forward earnings, which is cheap relative to the industry. But if you look at growth expectations, revenue growth expectations are 2%. So this is a company that's just not expecting to grow at all. And net profit margins are under 2%. So we're talking about razor thin margins and not growing at all. So even though it's trading at 12 times forward earnings, which is actually a discount to its peers, I still think that there's downside risk to this particular stock, and it's likely going to follow a lot of what the other supermarket stocks have been doing this year, which is falling pretty quickly and very fast. Spotify is another one that I think is worth paying attention to here right now. Similar to a lot of the stocks that I'm showing you, Spotify, as you can see, the trend quality has really deteriorated all year and just recently started to turn all red. This is showing that this could potentially start falling here. Spotify, like a lot of stocks, trades at very rich valuations. It's trading at 49 times forward earnings, which is basically double the industry. And in many ways, you can justify a higher valuation because it grows very fast. It has expected revenue growth around 17%. That's in the same range as Meta that I was talking to you about, right? But like I said, 17% revenue growth. Maybe you trade at 25, 30 times forward earnings, right? But this is trading at 50 times forward earnings. And those stocks that, when we talk about Alphabet and Meta, had net profit margins of north of 30%. So when you have, revenue growth in that 17% range and you have very fat margins, you can justify 25, 30 times forward earnings. But the problem is that Spotify's net profit margins are under 5%. You might not realize this. You think Spotify as a streaming service where there's very little, inventory or overhead, is a hugely profitable business, but it's not at all. It's a very streaming music is actually a very thin profit margin business. So the fact that profit margins are under 5%, yes, it's growing very fast, but it's just not very profitable. So the fact that it trades at 50 times forward earnings, I think is a huge risk. And I think the market's starting to see that as well. We're starting to see some downside. Caesars Entertainment, this is one that I've talked about a lot in the last few weeks, but it has turned lower substantially here in the last week or so, even though it's had a bit of a pop after that decline here. Our downside target is 18. We were just a few cents away from reaching our $18 downside target. So I'll continue to look for that last move here to the downside and completing our expectations here. And then Philip Morris is our last bearish opportunity here. Philip Morris has underperformed outperformed substantially here in the last week or so. And we basically started looking at this when it's broke below this 170 level and came back to retest this level as resistance. And the stock has continued to move lower. Our downside target is 130. So we're not quite there yet, but we're making our way down there. Philip Morris trades at around 17 times forward earnings, which is a little bit higher than the industry average. But what Philip Morris is really what concerns me about Philip Morris is that profit margins have continued to tumble here in the last few quarters. We're now talking about profit margins that are around 21% versus the industry average is around 33%. So profit margins tumbling for a tobacco stock is really um, a big concern because these types of stocks are generally you used to be high profit margin, returned a lot of cash to shareholders in the form of a dividend. That's now at risk, and I think for those reasons, Philip Morris is looking far less attractive as a stock for a lot of kind of income focused investors, and that's why the stock has really fallen quite a bit here this year. And I think we're getting towards our downside target here for Philip Morris. So with that covers what I want to share with you here today. I hope that helps give you a context of kind of where we sit from a bigger picture perspective, and then show you our thoughts here for opportunities in the markets. Thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.